Welcome to our exploration of cost structures in economics. Understanding costs is essential for any business or individual interested in how resources are allocated and profits are maximized. In this video, we'll break down the different types of costs you might encounter, including fixed costs, variable costs, total costs, average costs, and marginal costs. We'll also visualize these concepts with cost curves, making the relationships clear and intuitive. Whether you're a student, entrepreneur, or just curious about economics, this journey will help you grasp the foundations of cost analysis. Let's start by defining what costs mean in the context of production. Costs are expenses that do not change with the level of production. Think of things like rent, salaries of permanent staff, or insurance payments. No matter how much you produce, these costs remain constant in the short run. For example, if a bakery rents a space for $1,000 a month, that amount stays the same whether they bake 10 loaves or 1,000 loaves. Fixed costs are crucial for planning because they represent the baseline expenses a business must cover regardless of output. Next, let's see how variable costs differ from fixed costs. Variable costs, on the other hand, fluctuate with the level of production. These include expenses like raw materials, hourly wages, and utility costs that increase as more goods are produced. For instance, the more bread a bakery bakes, the more flour and yeast it needs to buy. Variable costs are directly tied to output, making them a key factor in decision-making about scaling production. By understanding variable costs, businesses can better predict how changes in production levels will impact their overall expenses. Now let's combine fixed and variable costs to understand total costs. Total cost is the sum of fixed and variable costs at any given level of production. It represents the complete expense a business faces to produce a certain quantity of goods or services. For example, if a bakery has $1,000 in fixed costs and $500 in variable costs for producing 100 loaves, the total cost is $1,500. Tracking total costs helps businesses set prices, forecast profits, and make informed decisions about expanding or reducing production. Next, we'll look at how to measure costs per unit with average cost. Average cost, also known as unit cost, is calculated by dividing total cost by the number of units produced. This metric tells us how much, on average, it costs to produce each item. For example, if the total cost for 100 loaves is $1,500, the average cost per loaf is $15. Average cost is useful for comparing efficiency at different production levels and for setting competitive prices. As production increases, average cost often decreases due to the spreading of fixed costs. Now let's explore marginal cost, which focuses on the cost of producing one more unit. Marginal cost is the additional cost incurred by producing one more unit of output. It's calculated by finding the change in total cost when output increases by a single unit. For example, if producing 101 loaves costs $1,515, while 100 loaves cost $1,500, the marginal cost of the 101st loaf is $15. Marginal cost is vital for decision-making as it helps businesses determine the optimal level of production. When marginal cost equals marginal revenue, profit is maximized. Next, let's see how these costs are visualized with cost curves. Cost curves are graphical representations of the different types of costs as output changes. They help us see how fixed, variable, total, average, and marginal costs behave as production increases. Typically, the fixed cost curve is a horizontal line, while variable and total cost curves slope upward. Average and marginal cost curves often have a U-shape, reflecting economies and diseconomies of scale. These visual tools make it easier to analyze cost behavior and make strategic decisions. Let's start by looking at the fixed cost curve. Fixed cost curve is a straight horizontal line on a graph, showing that fixed costs remain unchanged regardless of output. No matter how much is produced, the fixed cost stays constant. This visual reinforces the idea that fixed costs are independent of production volume. It's a foundational concept for understanding how other cost curves are constructed. Next, let's examine the variable cost curve and see how it behaves as output increases. Variable cost curve starts at the origin and rises as output increases. This upward slope reflects the fact that variable costs grow with each additional unit produced. The shape of the curve can vary depending on the efficiency of production processes. In some cases, the curve may be linear, while in others, it may curve upward more steeply due to diminishing returns. Understanding the variable cost curve helps businesses anticipate how costs will change as they scale up. Next, let's add fixed and variable costs to get the total cost curve. Total cost curve combines fixed and variable costs. It starts at the level of fixed cost and rises as variable costs are added with each unit of output. The curve shape mirrors the variable cost curve but is shifted upward by the amount of fixed cost. This visualization helps businesses see the overall expense of production at different output levels. Next, we'll look at the average cost curve and what it reveals about production efficiency. Average cost curve typically has a U-shape. At low levels of production, average costs are high due to fixed costs being spread over few units. As output increases, average cost falls, reaching a minimum point. Beyond this point, average cost may rise again due to inefficiencies or diseconomies of scale. This curve is crucial for identifying the most efficient scale of production. Next, let's examine the marginal cost curve and its relationship to average cost. Marginal cost curve shows the cost of producing each additional unit. It often intersects the average cost curve at its lowest point. When marginal cost is below average cost falls. When marginal cost is above average cost rises. This relationship is key for understanding how to optimize production. The marginal cost curve helps managers decide when to increase or decrease output. Now let's compare all these curves on one graph for a complete picture. We plot fixed, variable, total, average, and marginal cost curves on the same graph. We get a comprehensive view of cost behavior. This combined graph helps businesses analyze how costs interact and change with output. It's a powerful tool for making pricing, production, and investment decisions. By understanding these relationships, managers can better navigate the complexities of cost management. Next, let's discuss the importance of cost curves in real-world business decisions. Cost curves are more than just academic concepts, they have real-world applications. Businesses use them to determine the most efficient level of production, set prices, and forecast profits. By analyzing cost curves, companies can identify when to expand or contract operations. Understanding cost behavior also helps in budgeting and strategic planning. Next, let's look at how fixed and variable costs impact break-even analysis. Break-even analysis uses fixed and variable costs to determine the output level at which total revenue equals total cost. This point is crucial for businesses as it marks when they start making a profit. By understanding their cost structure, companies can set realistic sales targets and pricing strategies. Break-even analysis is a practical application of cost curves, helping managers make informed decisions. Next, let's see how average and marginal costs influence competitive pricing. Average and marginal costs play a key role in setting prices. Businesses aim to price products above average cost to ensure profitability. Marginal cost helps determine the minimum price at which additional units should be sold. In competitive markets, understanding these costs is essential for staying profitable while attracting customers. Next, let's explore how economies of scale affect cost curves. Economies of scale occur when increasing production lowers the average cost per unit. This happens as fixed costs are spread over more units and operational efficiencies improve. The average cost curve reflects this by sloping downward at first. However, beyond a certain point, diseconomies of scale may set in, causing average costs to rise. Understanding this helps businesses plan for growth. Next, let's discuss the impact of technology on cost structure. Technological advancements can significantly alter cost structures. Automation and improved processes often reduce variable costs and shift cost curves downward. This allows businesses to produce more efficiently and remain competitive. Investing in technology is a strategic move for long-term cost management. Next, let's see how cost curves help in budgeting and forecasting. Cost curves provide a framework for accurate budgeting and forecasting. By understanding how costs behave at different output levels, businesses can predict future expenses and set realistic financial goals. This proactive approach helps avoid surprises and ensures resources are allocated efficiently. Next, let's look at how cost structures influence investment decisions. Understanding cost structures is vital for making smart investment choices. Investors analyze fixed, variable, and marginal costs to assess the profitability and risk of new projects. Cost curves help identify the most efficient scale of operation, guiding capital allocation. This knowledge supports long-term business growth and sustainability. Next, let's discuss the role of cost curves in product development. During product development, understanding cost curves helps businesses estimate the expenses involved in bringing a new product to market. By analyzing fixed and variable costs, companies can set realistic budgets and pricing strategies. Marginal cost analysis ensures that scaling production remains profitable. This approach minimizes financial risk and maximizes the chances of success. Next, let's see how cost curves affect supply decisions. Cost curves are essential for making supply decisions. Businesses use marginal cost to determine how much to produce and supply to the market. When marginal cost equals market price, firms maximize profit. This principle guides day-to-day operations and long-term planning. Next, let's explore how cost structures impact pricing flexibility. Deep understanding of cost structures allows businesses to adjust prices in response to market changes. By knowing their fixed and variable costs, companies can offer discounts or promotions without risking losses. Marginal cost analysis helps identify the lowest sustainable price. This flexibility is crucial in competitive industries. Next, let's discuss the impact of cost structures on profit margin. Profit margins depend on the relationship between costs and revenue. By minimizing average and marginal costs, businesses can increase their profit per unit sold. Cost curves help identify areas for improvement and cost-saving opportunities. Maintaining healthy profit margins is essential for long-term success. Next, let's see how cost structures influence expansion decisions. In considering expansion, businesses analyze cost curves to predict how costs will change with increased output. Economies of scale can make expansion attractive, but diseconomies may raise average costs. Careful analysis ensures that growth strategies are financially sound. Next, let's look at the role of cost curves in competitive strategy. Cost structures influence competitive strategy by determining how low a business can price its products while remaining profitable. Firms with lower average and marginal costs can outcompete rivals by offering better prices or higher margins. Cost leadership is a common strategy in many industries. Next, let's discuss the impact of cost structures on risk management. Understanding fixed and variable costs helps businesses manage financial risk. High fixed costs increase risk during downturns, while variable costs offer more flexibility. Cost curves guide decisions about cost structure to balance risk and reward. Next, let's see how cost analysis supports sustainability initiatives. Sustainability initiatives often involve upfront investments that increase fixed costs but reduce variable costs over time. Cost curves help businesses evaluate the long-term benefits of eco-friendly practices. By analyzing these curves, companies can make informed decisions that support both profitability and environmental responsibility. Next, let's look at how cost structures affect pricing in different industries. Different industries have unique cost structures. For example, manufacturing often has high fixed costs, while service industries may have higher variable costs. Understanding these differences is key for benchmarking and strategic planning. Cost curves provide a universal framework for comparison. Next, let's discuss the importance of monitoring cost curves over time. Regularly tracking cost curves helps businesses respond to changes in input prices, technology, and market conditions. This ongoing analysis ensures that strategies remain effective and costs are controlled. Adapting to shifts in cost structures is essential for staying competitive. Next, let's see how cost curves support financial reporting. Cost curves provide valuable data for financial reporting. By breaking down fixed, variable, and marginal costs, businesses can create detailed reports for stakeholders. Transparent reporting builds trust and supports better decision-making. Next, let's explore how cost analysis aids in negotiations with suppliers. Clear understanding of variable costs empowers businesses during supplier negotiations. By knowing their cost structure, companies can negotiate better terms and identify cost-saving opportunities. This strategic approach strengthens supply chain management. Next, let's discuss the role of cost curves in performance evaluation. Cost curves are useful for evaluating business performance. By comparing actual costs to projected curves, managers can identify areas for improvement. This analysis supports continuous improvement and operational excellence. Next, let's see how cost structures influence outsourcing decisions. Businesses often use cost analysis to decide whether to outsource certain functions. By comparing internal and external costs, companies can choose the most cost-effective option. Marginal cost analysis is especially helpful in these decisions. Next, let's discuss the impact of cost structures on innovation. Innovation can reshape cost structures by introducing new technologies or processes. These changes often lower variable costs and shift cost curves downward. Businesses that innovate effectively gain a competitive edge. Next, let's see how cost curves support strategic partnerships. Cost analysis helps identify potential partners who can offer cost advantages. By understanding their own and others' cost structures, businesses can form alliances that improve efficiency and profitability. Strategic partnerships are a powerful tool for growth. Next, let's discuss the role of cost curves in crisis management. During crises such as economic downturns, understanding cost structures is vital. Businesses can quickly identify which costs are fixed and which are variable, allowing them to make rapid adjustments. This agility helps organizations survive challenging times. Next, let's see how cost curves inform government policy. Governments use cost analysis to design policies that support economic growth and stability. By understanding industry cost structures, policymakers can create incentives or regulations that promote efficiency. Cost curves are a valuable tool for public sector decision-making. Next, let's discuss the educational value of cost curves. Learning about cost curves equips students and professionals with essential analytical skills. These concepts are foundational in economics, business, and finance courses. Mastery of cost analysis supports better decision-making in any career. Next, let's see how cost curves relate to market structures. Different market structures like perfect competition, monopoly, and oligopoly affect cost curves and pricing strategies. For example, monopolies may have higher fixed costs but can spread them over more units. Understanding these dynamics is key for strategic planning. Next, let's discuss the limitations of cost curves. While cost curves are powerful tools, they have limitations. Real-world costs can be unpredictable and not all expenses fit neatly into fixed or variable categories. External factors like regulation and market shocks can also impact costs. It's important to use cost curves as guides, not absolute rules. Next, let's see how to apply cost analysis in practice. To apply cost analysis, businesses gather data on fixed and variable costs, calculate total, average, and marginal costs, and plot cost curves. This process supports informed decision-making across all areas of operation. Regular review ensures strategies remain effective. Next, let's summarize the key takeaways. Understanding fixed, variable, total, average, and marginal costs is essential for effective business management. Cost curves provide valuable insights for pricing, production, and strategic planning. By mastering these concepts, businesses and individuals can make smarter, more profitable decisions. Next, let's look at some practical tips for cost management. Effective cost management involves regularly reviewing expenses, seeking efficiencies, and adapting to changes in the business environment. Using cost curves as a guide, managers can identify opportunities for savings and growth. Staying proactive ensures long-term success. Finally, let's wrap up with a summary of what we've learned. Summary: cost structures and cost curves are fundamental tools for understanding and managing business expenses. By analyzing fixed, variable, total, average, and marginal costs, businesses can optimize operations and achieve their goals. Whether you're running a small business or studying economics, these concepts are invaluable for success. Thanks for joining this deep dive into cost curves. Keep exploring and applying these insights in your own work.